So I get asked all the time, what are the biggest mistakes people make with their taxes? And I continually see kind of the same things over and over again with all the tax returns that I see and all the financial planning I'm doing. Probably the biggest thing that I see on a consistent basis is really more of a mindset than it is anything else. Most people have an absolute aversion to owing the government any money come tax time. Everybody loves to get the refund. They love to have that refund. It's almost like Christmas morning for a little kid. But the problem is when you think about it, it doesn't make any financial sense to get a big refund. Now, if you get the earned income credit, if you're lower income folks, that's probably unavoidable. You're going to get a big refund at that point. But for the people who aren't getting the earned income credit, it doesn't make any financial sense. Essentially, what you're doing is giving the government an interest-free loan. So what do I mean by that? Well, let's look at it. So let's say throughout 2014 that you were giving the government each month from January through December $200 more than what your tax liability was. So that means when you do your taxes in 2015 up until April 15th, you're going to get about a $2,400 refund. Again, $200 per month for 12 months. So now you're happy when you get that $2,400 refund. You just think you won the lotto. The reality is, for 12 months throughout 2014, you gave an extra $200 to the government. They held that money and didn't give you a penny in interest. So let's just look at kind of the opportunity cost for doing that. Let's say you have a credit card debt, okay? And let's say that credit card is at 12%. If you'd have gotten that $200 per month through the year, that means you would have paid off $2,536 of that debt if you put that $200 each month towards your credit card debt. This means you would have saved $136 of interest. That's pretty substantial. Instead, you just gave it to the government and you didn't get a penny for that. So if over the next few years you get that $136, you can pay off your credit card debt pretty quickly. Or even, let's say, a mortgage at 4%. Again, if you take that $200 a month, at the end of the year, you would have paid off an extra $2,444 of your mortgage. This means you would have saved $44 in interest. And you can reverse this too. So let's say you don't have credit card debt or you don't want to pay your mortgage off quicker. Let's say you were investing this money each month and you earned 4%, or you got lucky and you earned 12%. That's $44 in interest you would have earned at 4%, or $136 if you could get 12%. So what Americans need to do, the first thing, is change their mindset. Think refund equals bad, owing equals good. Now, you don't want to owe enough to where you're going to incur any penalties or interest, but if you can owe at least a couple $100, that means now all of a sudden the government has given you an interest-free loan. So the first mistake I see from a financial standpoint is people going for the big refund. The second thing I find a lot is people continually miss small but important deductions. Remember, every deduction counts. Every deduction is important. But there are a lot of little things that people miss out on. The first one deals with charity. A couple things with charity. One of them is mileage. Most people don't realize you can deduct all the mileage that you undertook for all of your charitable endeavors. So if you go to the food kitchen and you help feed the hungry or the homeless, if you go to your child's school or your grandkid's school to help them read, to help the teacher, grade math tests, anything like that, that mileage is deductible. That's, it's not going to make or break you, but it adds up because usually people do something for charity during the year and that could be deducted. Another thing, while we're talking about the kids or grandkids, a lot of times I find that I have parents or grandparents, they go into the schools, they take cookies, they take food, they make pasta dishes, they make this, they make that. Or they just go in and they buy supplies for the teacher. They can write that off. You can write off what it takes to make a lasagna for the class. Or if you're buying scissors and paper for the class, you can write that off. Keep the receipts. The second thing is kind of similar. Instead of charity mileage, it's medical mileage. Now, it's awfully difficult to write off medical expenses. If you're under age 65, it has to be out-of-pocket medical expenses greater than 10% of your adjusted gross income. For over 65, that number goes to 7.5%. So it's awfully difficult to do. But one thing that people often overlook, again, is that medical mileage. A lot of times people are close, or they do have enough to write off some medical expenses, especially if you have orthodontics or a major surgery. That mileage can add up. That's a mileage every trip you took to see the dentist, the orthodontist, to see your doctor, to go get prescriptions. All of that mileage can be written off, but I find that people just don't track it. A third thing that's kind of a small but important deduction is job hunting expenses. So if you're out of work, all of the expenses you undertake to find a job in your current career, that's deductible. This includes, paper to do your resume, includes any kind of counseling skills. It includes mileage, driving to and from interviews. All of that can be deducted. The lifetime learning credit. This is a credit for people who are taking college courses or vocational school courses. It doesn't have to be for a degree. So let's say you're retired and you went to the local community college and you took a Spanish class or you took a writing class. You can write that off, possibly, depending on what your income level is. And essentially what it's going to be is 20% of the tuition that you paid. So let's say you spent $300 on a class at the community college. That's possibly a $60 tax write-off for you. It's a credit. It's not even a deduction. It's a credit, which is even more important. I just find a lot of times people do things and they don't take that lifetime learning credit. Another thing that people don't write off is a home office. They're very afraid that the government's going to come after them if they do a home office deduction. So even if you have a small business and you're not really making a whole lot of money from it, people are afraid that's going to incur an audit from the IRS. The thing is, if you're using it for business or if you're using it for your job, you might be able to take that home office deduction. It can really add up. It can really help. So don't be afraid to take that. The third mistake kind of deals with the second one. People don't track their deductions throughout the year. So what they do is they get to the point where they're about to do their tax return and they try to sit and think about, well, what charitable miles did we have? What charitable expenses did we do? And then they always end up missing out on things because they're not completely sure of all the charitable deductions they had, or the medical mileage, or all kinds of expenses that they possibly could write off. And they underestimate the amounts because they're afraid if they get audited, then the IRS is going to come after them. So the key is, with some minor effort during the year, you can actually be ready for tax time. And the thing is, with technology, there are some free tools out there that can help you, again, with little effort, so that when tax time comes, you have got a complete list of all your expenses, of all your mileage, everything like that. So it makes it very easy to do your taxes, plus you're getting your full deduction. That's what we want, people. The first thing, a really good tool that I use, it's called Shoeboxed. So what this does is, as soon as you have a receipt for something, let's say you buy cookies for your grandchild's classroom. Well, you just take a photo of the receipt. Now you've got it. You can categorize it as a charitable deduction, and then you're going to drive to your child's school. Well, Shoebox, you can either take a note of the mileage you did, or it can actually use the GPS on your phone to track the actual miles traveled. Now, I'm going to warn you, it is a battery drain when you do that, but how easy is that? So then you record the mileage and it does it to the foot. You could, you get exact mileage with that. Another kind of benefit with Shoebox, which isn't necessarily dealing with taxes, but it also can help you manage all the business cards you collect over the year. Another good option is a PDF reader. I use this as well. I'll scan receipts here. The nice thing is, as soon as I scan the receipts, I can send it to a Dropbox. So boom, I just send it right to a Dropbox folder or iCloud. You send it that folder for tax time, and you've got it all right there. And it just takes a couple seconds to scan those receipts. You can use the camera right on your phone. So don't wait until tax time to think about your tax deductions. Do it during the year, and you can do it for free. You can do it with your smartphone, and it won't take you much time. The next mistake I see people making all the time is they don't take losses when they have them. So the first thing is, if you sell a stock or a mutual fund or something like that and you have a gain, go ahead and look for some positions that have a loss. Sell that loss. It helps to offset the gain. And then you can kind of reduce your taxes with that. Or another big thing, if we have a big downturn in the markets. You know, I know buy and hold is a very important concept with investing, but if you get a big loss, go ahead and sell the holding. Now you get that loss for tax purposes. And then you can go out and buy a similar holding. It can't be identical, but a similar holding. And then when the market turns back around, you'll get a gain on that holding. Now you have to be careful here. You don't, you know, if you sell the Spider S&P 500 and then you take a loss there, you can't buy that vehicle, that exact vehicle back within the next 30 days. Otherwise, it's called a wash sale, and the government will disallow that loss. But you could go out and maybe buy the Vanguard Total Stock Market Index, or you could buy an iShares Large Cap Index, something along those lines, which is essentially the same holding, same asset class, but then you still get to take that loss. So that's something I see quite often. The last thing I see happening is people don't track any kind of tax item that carry over from one year to the next. Now, a lot of times if you're using the same tax preparer, they'll do that. Or if you use TurboTax or something along those lines, that'll track it as well. But I still do find a lot of people miss out on this. The first area where people make a mistake is with non-deductible IRA contributions. So if you make a contribution to a traditional IRA and due to income or some other reason you can't deduct that entire amount, well, you've made a non-deductible contribution. So in theory, any non-deductible contribution that you've made, when you go back and when you retire and you pull money out of your IRA, a portion of that is not going to be taxable. But the problem is you have to track that. If you don't track that, the government's going to say, well, prove it to me. Prove to me that you have a non-deductible contribution. And if you don't have that, then they're going to say the whole thing is taxable. So the form that you use for this is called the 8606. So this is something you have to track through the years. And if you do it when you're in your 30s, it's going to be awfully difficult to track that until you get to retirement at age 65 or 70. So it's definitely something that people fail to follow up with, but it's very important to do so. Another thing is a capital loss carry forward. So let's say you have sold stocks after 2008 or 2009 and you have a big loss. Well, the government only allows you to take up to $3,000 of a loss in any given year. So you might have had a loss carry forward. Well, the problem is sometimes I've seen it where people haven't carried that forward to the next year's tax return. They don't look for it, or they go to a new tax preparer who fails to look at their last year's tax return and insert that carry forward. Well, if they do that, then all of a sudden that capital loss is gone. It's just something that people won't think about. So it's very important you look at that. Another thing for people who have a small business, depreciation. So you buy a computer, you buy a printer, you buy any kind of capital asset that has a longer shelf life than 1 year. Well, you have to depreciate that property. And the nice thing about the depreciation is you can take it over time. You can have a tax deduction for several years, but sometimes I've seen it where people don't track that going forward. So they get 1 year of depreciation, and then for whatever reason, it doesn't get onto the next year's tax return. So now they've missed out on a nice little tax break. So real quick, those are the 5 things that I see quite frequently, the top 5 mistakes that taxpayers make. I hope you found this educational and intriguing. I hope that maybe you might change the way you do your taxes to help benefit you and get a bigger tax refund. And again, just to give you a quick plug about Picket Fence Tax Service, we're really trying to change the tax experience for customers. We've got a coffee shop environment. You come in, you get a latte, you can get a coffee, you get a pastry, you sit in comfortable chairs and couches, serve our Wi-Fi for free. We've got magazines. We're trying to take the stress out of taxes. So if you or somebody you know might like our approach, please send them to picketfencetax.com. So thanks again for listening, and I hope you found this useful. Take care.